So, you're thinking of starting a business in Malaysia? That's awesome. A partnership can be a fantastic way to get going, but let me tell you, getting the legal and tax side wrong, well, it can be a real disaster. Let's break down exactly what you need to know to get it right from the very start. You've got that brilliant idea, and you've found the perfect co-founder. You're ready to go, right? It's such an exciting time. But hold on, because the decisions you make right now, the legal and tax ones, they're going to define the entire future of your business. And when I say everything, I mean everything. The structure you choose isn't just a piece of paper you file. No, it directly hits your personal bank account. It determines how much personal risk you're taking on, and it tells the Inland Revenue Board, or LHDN, exactly how to tax you. This is a very big deal. But hey, don't worry, we're going to break it all down for you. By the end of this short explainer, you are going to have the core knowledge you need to make a smart, informed decision for your brand new business. Okay, let's start with the official stuff. The Partnership Act of 1961 says it's basically people working together to make a profit. Sounds simple, yeah? But here is the absolute key for taxes. A standard partnership is what's called a transparent vehicle. Think of it like a clear pipe. The business itself doesn't pay tax. Instead, the money flows right through the pipe to the partners, and they are the ones who get taxed individually. Right, so before you pick a business structure, you've got to understand the different hats people can wear. Let's look at the 5 main types of partners you'll find under Malaysian law. First up, we have the active or general partner. This is probably who you think of when you hear the word partner. This is the person who's in the business every day, hands-on, making the big decisions, really running the show. Now, look at this list. An active partner puts in money and skills. They get a say in decisions, and they often get a salary. But, and this is a huge but, they have unlimited liability. We're going to come back to that phrase because it is so important. And for taxes, every single cent they get, salary, interest, their share of the profit, it's all taxable. Next, we have the total opposite, the sleeping or dormant partner. The best way to think of this person is as the silent investor. They put money into the business, but that's it. They're not involved in the management at all. So they just contribute cash, no management. And they only get taxed on their slice of the profits. But here's the part that catches so many people out. In a conventional partnership, they still have that unlimited liability, just like the active partner. That's a massive risk for someone who's completely hands-off. Okay, so beyond the active and sleeping partners, there are 3 other, more specialized roles you might come across: the limited, the nominal, and the minor partner. They're not as common, but you need to know they exist for certain situations. This little table really shows you how different the roles can get. Take a limited partner, usually found in an LLP. Their risk is capped. They can only lose what they invested. A nominal partner, they just lend their famous name, maybe for credibility, and only get taxed if they get a fee. And a minor, they can get profits, but they can't be held responsible for debts. The main takeaway here is just how much the liability and the tax can change, depending on what kind of partner you are. All right, we've talked about the who. We know the players. Now let's talk about the what, the actual legal structure of the business itself. And folks, this is the big decision. For most people starting a business in Malaysia, it really boils down to this one single question. Are you going to be a conventional partnership, or are you going to set up a limited liability partnership, an LLP? If you remember only one single thing from this entire explainer, please make it this slide. In a conventional partnership, you have unlimited liability. That means if the business gets into debt, they can come after your house, your car, your savings. In an LLP, you have limited liability. Your personal stuff is safe. The most you can lose is what you've put into the business. Honestly, this is a total game changer. Let's break that down even more. A conventional partnership isn't seen as a separate person from its owners. You and the business are one and the same. But an LLP? It is its own separate legal entity. That's the whole reason the liability is different. And it also means the taxes are handled completely differently. In a conventional setup, the partners pay tax. In an LLP, the LLP itself pays the tax, kind of like a company. That's why you even use different tax forms, Form P versus Form PT. Oh, and a quick note for all the professionals out there, lawyers, accountants, engineers. You might form what's called a professional partnership. Now, it might have its own special industry rules, but when it comes to taxes, it's treated exactly the same as a conventional one. The income just flows through to the partners. So we know who gets taxed and what gets taxed, but let's quickly peek behind the curtain and see how the tax actually gets calculated. Let's follow the money. For a conventional partnership, it's a bit of a process. First, the business does its own math to figure out the total profit pot. They call this divisible income. Then that big pot of money is divided up between the partners based on whatever they agreed to. Finally, each partner takes their share, puts it on their own personal tax return, and pays the tax on it. Now, compare all those steps to an LLP. Because the LLP is its own legal person, the whole thing is way, way simpler. The LLP calculates its own income, and it pays its own tax. Done. The money that gets shared with the partners after that isn't taxed again. And how much tax does the LLP pay? It's a nice, predictable, flat rate. As of the 2025 assessment year, that rate is 24% on its chargeable income. It's totally different from the conventional way, where your final tax bill depends on your personal income bracket. Whew, okay, we have covered a lot of ground really fast. So let's just take a breath and wrap this up by hammering home the most crucial points that you need to walk away with. Let's lock these in. 1, a conventional partnership is tax transparent. The partners pay the tax. 2, an LLP is a taxable entity. The business pays the tax. 3, and this is a classic mistake, a partner's salary is not a business expense for a conventional partnership. It's just considered an early withdrawal of their profits. And finally, your partnership agreement is king. It decides how the money is split, and that, in turn, decides everyone's tax bill. Look, at the end of the day, this isn't just about theory or boring rules. Understanding this stuff is what gives you the power to pick the right structure for your dream, to protect your personal assets, and to make sure you're doing things right with LHDN from day one. So there you have it. You are now armed with the foundational knowledge of Malaysian partnership law and tax. You know the rules of the game. The only question left is, what amazing business are you going to build?